You know, I can't tell you how many times I've been asked the last several months, Jim, how is the presidential election going to affect the stock market? Or how might the outcome of the election, maybe more appropriately? I thought it would be worthwhile and go back and look at history. And there are several things I wanted to look at historically. So I went all the way back to 1789 and we looked at all the presidential elections and how the stock market has done in different presidents' terms. And there are three things I really want to focus on that we learned by doing this research. And one is, how does who in office, how does that affect the stock market? Okay. Number two is, are there things we can learn from how investors are behaving in various presidential terms? And are there things we learn we shouldn't be doing? And then number three, what about other economic conditions? You know, we're in a pandemic right now. And in other presidents' terms, there have been other economic realities. So we did go back to 1789. And remember, it's not just what party holds the White House, but who holds the Senate and the House of Representatives. So do we have a unified government or do we have a divided government? So we looked at three potential scenarios. One is, was there a Democratic sweep of all three of those branches? The second is, was there a Republican sweep? And the third would be a divided government. So whoever was in the White House, we had at least one body of Congress that was in the other party, either the Senate or the House, much like we've had the last, couple of years, and we had throughout actually several of the last president's terms. So what we ultimately found is that over time in the 4-year presidential terms, markets are remarkably up similar amounts, usually about 8.5 to 9% per year over the 4-year term, compounded annually. Maybe in the low 8s, but in that range. In other words, there was not a big variance one way or the other. Now the reality is, I could go back and pick shorter periods of time, and we can always see anomalies where something happened completely differently. Okay, but over all of those years, that was what the data said. Now, that doesn't mean that's what's going to happen in the future, but that's what the data said, is that over time, markets are resilient and markets make money, the stock market. Now, then the second thing is, what about investor behavior? So it's kind of interesting. One thing we did find is when we looked at 4-year presidential terms, we did find some trends within the 4 years. And the trends we found was that in the first 2 years of a president's term, the stock market generally did more poorly than the last 2 years of a presidential term. Now, that could be explainable a lot of different ways. Uncertainty about new government policy, or maybe it takes a while for government policy to make an impact. We've also got midterm elections in there. Bottom line, the last 2 years do better, historically, than the first 2 years. Now, again, there can always be exceptions to that, but that's what the data says over time. Investor behavior, however, has been the complete opposite. In the first 2 years, when markets were doing more poorly, investors were pouring money into the stock market and not into money market mutual funds, money markets and cash equivalents. The second 2 years, when markets were doing better, people were putting more money into money markets and cash equivalents. So investor behavior was the opposite of what they should have been doing. I think the lesson there is we have to be very careful that we don't let our emotions drive our short-term decisions, okay? Now, what about other economic realities? You know, when we really look at history, it's been other economic realities that have really been driving the market in different, over time, all right? We're in a pandemic right now. We have a recession. Now, the flip side is we have massive stimulus from the federal government, both in terms of congressional spending and actions of the Federal Reserve. And that is really helping buoy the stock market particularly. And you know what? All signs are that's going to continue to happen regardless of who holds the White House and who holds Congress. We're probably going to see a good bit more government spending. We're probably going to see the Federal Reserve be very aggressive in helping the economy. The reality is, in the short term, we just have no idea what may happen. But when we invest at risk, we're supposed to be a longer-term investor, 4, 5, 6 years down the road. So volatility over the next 3 or 6 months, we're not as worried about because we don't need our risk investments for maybe 5 or 6 years. So we've got to have more secure, stable investments that we can draw from in the short term. And then to me, the bigger issue is the longer term impacts of all this government spending and policy from the Federal Reserve. How are we going to unwind all this? And how does your portfolio need to evolve over time? Because I'll tell you, what worked in the past may not work in the future. And that's why a good financial plan that can be dynamic and evolve over time, but has good short-term solutions for income with good long-term solutions for growth, is what investors and retirees need in today's world.